Hello and thanks for checking out ChartGuys.com. We're proud to be one of the most successful technical analysis communities online, teaching you the skills to become a more confident, effective, and informed trader. Join our community of hundreds of analysts worldwide working together to learn the charts, generate profit, and achieve financial independence. For access to daily live chart analysis and market coverage, a thriving chat community, along with dozens of hours of exclusive educational materials. We look forward to seeing you. Let's check out some charts. Hey everyone, so we're going to talk about the market. We're going to talk about SPY, IWM QQQ, tech sector, financial sector, volatility index, and we're going to try and answer the question, should we be looking to buy the dip? Whenever we see fear like this, that's always when emotions are the highest and people are wondering, is this the end? Are we about to crash? Or is this one of those great dip buying opportunities? So essentially we're entering an area where the amount where we've pulled back, we're either going to see one of two things happen. We're going to see the most significant bearish pullback since the 2008 collapse, or we're going to see the bulls buy the dip just as they have multiple times in the face of significant weakness since 2008. So February, again, we have the example where the bulls bought the dip and we headed to all-time highs. So the recent past, the last 10 years, the play has been to buy during this time. So that's a potential. There's two strategies. I'll talk about it as a bull or a bear. Let's go through the analysis first, and then at the end, I'll talk about the long-term timeframes. I'll talk about strategies going forward in the short term, whether you're a bull or whether you're a bear, and different ways to play this market. So just going over the analysis, hourly time frame, we were heading into today after a significant bounce on the hourly. We had the low of support, the high of the bounce, and then pre-market rolls around, and we wake up and open our computers and say, all right, there's the hourly high or low attempt. If we cannot break the high of yesterday, and if we break the low of pre-market, that's a red flag. So the bulls were unable to break resistance. We pulled back. We broke the low of pre-market. And from that point on, we only have the low of yesterday as support. So that was a signal that the bears had control for the day. And they really had it significantly. On the 5-minute time frame, we had the 4 and the 8 exponential resistance levels, which I use on the shorter term time frames. I use them on all time frames. These are the 12 and the 26 here. But I had the 4 and the 8 up, and it just drove the price down until these bounces occurred. And what stands out to these bounces for me, and same with the hourly, again, the size of the hourly, you absolutely anticipate that because of that move and because of the bull volume increasing heading into it, you anticipate that the bulls will be able to form at least a higher low in an equilibrium before a bear break. To go straight to a bear break is unusual. And then we saw that on the 5-minute time frame multiple times today. Significant bull bounces with zero follow through. The 5-minute trend never confirmed a change. We broke the lower highs, but we never got the higher low and higher high confirmation of the new trend change. So again, a significant bull move that just gave it all back. And then we saw it again. This one was very notable. This was the most concentrated bull volume that we saw all day at that point. A solid bull move. We broke the lower highs. You look for the higher low to form, and it just never comes, and the bears take it back. So every bounce opportunity, the bears were selling into that, and it obviously led to a very weak bottom falling out at the end of the day. When the low of yesterday broke, there was no support nearby, and the bears ran with it. Excuse me. Another thing that stands out to me is the RSI levels. The RSI only dipped below oversold in the morning. And then because we had little bounces on the way down, we were grinding with that 30-minute or that 5-minute 30 RSI level holding. So we pulled back for 3+ hours and never broke that RSI into oversold conditions on even the 5-minute time frame. The 15-minute chart did the same thing, the brief dip, and then it stayed for hours and hours without getting oversold. In my opinion, this is just a theory that I came up with, and you can speculate on it with me if you want. I bet there are bots out there that trigger to buy under certain RSI conditions when things get extreme. And I do not think those bots were being triggered to buy because the RSI levels were allowed to cool off and then another leg down. And that kept this slow grind all day without things getting extreme. The more extreme those RSI levels get, the more of a V-shaped bounce you get. But with no extreme RSI levels, it's more of a slow grind down. So the bears are in complete control into the end of the day. We did close near the low. The next support level, not there on the daily. So the next support level on the weekly time frame, we're really looking down at 262.78 and then 256.73. So again, there's a lack of clear supports, and it's going to be two setups tomorrow. Number one, we're going to see a gap down open, in which scenario I would be looking to potentially be a buyer. And number two, if we see the hourly extended hours action give us a bear flag, which it is potentially doing, cool off some RSI levels. And then if we were to open and break the low of today first thing tomorrow, that would be a scenario that I would be looking bearish potentially. So it all depends on what the setup is pre-market. And I'm actually traveling tomorrow, so not sure what the video consistency is going to be in the next couple of days, but certainly not going to be actively trading this intense market right now while I am traveling. But I need a break, so it's all good. So looking at IWM, we've already followed through to a lower low. The biotech sector today was down 7+% at some point. That's an entire sector down 7%. The amount of market cap that is just erased in one day, that's astounding. So a lower high and a lower low. The RSI is almost in the teens on the daily. We closed at the low of the day with the bears having all momentum in their favor, and IWM has fallen off a cliff. At this point, we are down near these February lows. So we had a February support of 146.26 that broke, and the February dump low is fast approaching 141.28. I'm watching the February dump low as a key support on the S&P 500. If IWM breaks it first, I'm absolutely going to be making note of that and saying, all right, that might be a little bit of a heads up on what to look for SPY. At this point, it's 6 red weeks in a row. The weekly RSI is now getting oversold. And at this point, it took us about 1 month, 5 weeks, in order to take out about 8 months of bullish recovery. So it's significant. When the bounce gets going on the hourly time frame, we have to see the trend change. So the bounce got going yesterday. There was no trend change. The hourly trend has been in full control of the bears ever since the top of the bounce was hit. And then it's just lower highs and lower lows. So we are very clearly in a downtrend. And there's 2 scenarios to go about this market. If you're looking to buy the dip, you can wait for some trend changes, at least on the 5-minute, maybe on the 15-minute. More cautious. The longer time frame you wait for, the more cautious you're being. You're giving up some reward, but you're eliminating a lot of risk. So if you wait for the hourly trend to change, you're not going to nail the bottom. But if this is a dip buying scenario on the long term, as February was, if you looked at the trend change in February, you can go back and look historically. I'm not going to do it right now. There's too much data, but look at the different time frames. What time frame signaled the trend change in the bottom the soonest? Was it the hourly, or did we have a fake out? Was it the 4-hour? Was it the daily? So if you're looking for buying the dip, you want to ensure that the bounce starts at least a little bit, because you need a support level to be going off of. Because if you're trying to catch a falling knife, you have no reference point, and you say, the last thing you want to do is get into a position and say, well, we're really oversold. I'm just going to hold and ride this out. Because when you're falling through no support and things get this ugly, we very easily drop very quickly. And SPY can drop $1 in just a few minutes. And you don't want to be in that scenario. So by waiting for at least, a 15-minute trend change, you then have support levels to be going off of. And if you're trying to buy a dip and try and nail a bounce, you are trading counter the trend, and you have to protect that trade, and you have to use a stop loss, because I promise you things get ugly very quickly if you don't. So that strategy, if you're looking to buy this dip, if you're convinced the market bulls are fine and the monthly uptrend is going to remain on SPY, I can do that strategy. Wait for the 15-minute trend change. I can get stopped out one time. We see another leg down. I can try it again. I get stopped out again. If I'm keeping those losses small, the time that I do get it right is going to easily take back and give me more profit than losses than those few times if I keep those losses small and if I honor those stop losses. So it's very important to keep the losses small if you are trying to play counter trend. If you're trying to play bearish, at this point, I would be waiting for a little bit of a bounce. And again, tomorrow pre-market, if we see an extended hours bounce and we have a resistance level to be watching, you can use that resistance level as your stop and just exit if the hourly trend changes. So you can either be doing that or be a more patient bear. Wait for the daily bounce to get started and look for bearish entries. There is the monthly time frame that I'm watching. I pointed this out before on the S&P 500. In my opinion, if we are going to change the long-term monthly trend in the S&P 500, I doubt we're going to I do not think it's a more likely scenario that we're just going to drop right down and break the low of February levels in one straight shot. I do believe the bulls will buy the dip to defend 252.92 support. And if this trend is going to change, I'm not saying it's going to change, but if it is, in my opinion, it will be a head and shoulders pattern, and we'll get a bounce and some relief for multiple weeks before fading back down. And it's going to be a relief bounce, and everybody's going to say, oh, we're keeping the uptrend, everybody's buying the dip again like normal. And then if that fades and say, uh-oh, we're heading back down to that low, that's when things get ugly. So If the trend is going to change, that's something I'm looking for. So that is a reason I am looking to potentially be a buyer as we approach these supports. The ways that you're going to play this are either through individual companies, through ETFs. There's XLV, actually SPXL is what I'm trying to say. SPXL is the leveraged ETF for the bulls. You have another long-term strategy is going bearish the volatility index. We'll look at the volatility index in just a bit. And there's other ways to play it, options, further out calls. Again, protecting every single trade when you're trading against the hourly trend, the 4-hour trend, the daily trend. It's a lot of current coming against you, and you have to protect those trades. If you're looking bearish, you're either buying puts, you're either selling calls, you're shorting individual names, you're playing the inverse ETFs, SPXS, there's TQQQ. Again, Google has so much information in terms of how to play bearish, but first you need to decide which direction are you looking. Second, you need to decide what instrument am I going to play this with? Then you need to decide what your execution signals will be. So let's get into QQQ in the tech sector, because that is where the significant of the weakness started today, at least when we rolled over and broke the daily support level as well. So just in hindsight, we had the financial sector break to lower lows first. We had some individual names break to lower lows first. NVDA and the semiconductor sector is getting crushed. So they broke to lower lows first, then the financial sector, then the S&P 500, and then the tech sector right there with it. The Canadian MJ sector still has not broken those lows. They're probably going to be tested tomorrow. And again, this is a great opportunity. I just put out the Canadian MJ video, but we have two events, a sell the news event in Canada and this market weakness, creating some significant dips in those names. And that's another place to be looking to potentially play some bounces if the market bounces. So for QQQ, it was the same thing. The hourly bounce, they got no follow through on SPY. We couldn't break the high of yesterday. Every day is a lower high now, 5 days in a row. We closed at the low of the day. Bears in complete control. How we open tomorrow, either gap down open or a weaker open, is going to determine what we're looking at for the mindset to be in first thing tomorrow. And again, weekly supports are not nearby. We're just looking down at February lows. And if you look at the February low for the tech sector of 149, let's call it 150 for easy math, we're still over 10% above that level. So at this point, we have already pulled back about 10% plus, more than that. Let's see, the high was up at 187. We pulled back $22. So we pulled back 10% already. And if you think this is just going to straight dump down another month for another 10%, again, if that happens, it'll be the most significant crash since 2008. It's always a possibility, but I'm looking to go with what the trend has been for the last 10 years and look to buy the dip for me personally. But you better believe I'm stopping myself out. XLF, continuation to the downside. And James is still noting that there is still significant long-term call buying going on in this financial sector. We're talking hundreds of millions of dollars. BAC specifically is standing out for the amount of longer-term calls, and it looks like people are preparing for the market to bounce again. So big money is making bets on a bounce. It doesn't mean they're going to be right. I've said recently that the Canadian MJ bulls, the big money was out yesterday buying the dip, and there's a lot of big positions in the red that bought that dip from yesterday that didn't get followed through today due to the market weakness. But it's worth noting that there's a lot of big money betting on seeing a bounce just like always. Financial sector. So we already have the lower high and lower low. It already has changed the monthly trend, and we're in an area with no support. Look at the month run up we had in September 2017. We went from 23.29 straight up to 26. So now that we're under 26, we don't have any clear support on the weekly time frame. And a lot of names, because we ran so hard after the election the last 2 years, they're entering areas without a lot of support established, which is why the bears are easy to push the price down so fast. VIX, we did get some nice follow through, at least breaking the high of yesterday. It's all about the high of the bull break at 28.84, because again, it's either going to give us the daily equilibrium setup or a bull break. And just looking at what TVIX has done today, closer to its resistance, and actually it did break at the end of the day. So that's a significant difference. To go V-shaped recovery into continuation is obviously better than still having resistance nearby. So VIX on the weekly time frame, looking at that top of the last week bounce, and then we have compare it to February 2018, things were faster. Things were a lot more brutal. We dropped in the 7 days a higher percentage in February, and it's a little bit of a different scenario. It's more of a slow grind down, and slow is definitely not the right word to use, but if you're comparing it to February, it is slower. So again, a strategy that many traders and long-term investors take is entering bearish positions in these leveraged. You want to make sure they're leveraged because then you get time decay in your favor. These instruments are designed to go to zero, and anybody that went short on the February bull spike in that last week of the move ended up just fine in the long term, where we were up anywhere from the 60s to 150, and we dropped all the way down to the 30s eventually. So that is a pattern that people are going to look to take advantage of as well. And again, it's another one of those patterns that's been around for 10 years, since 2008. And the only way that this is not a good buying opportunity for bulls in the market is if we're going to see the most significant bearish dump since 2008. That's what we got. Protect yourself. Hedge long-term portfolios, do research and learn how to do so, and use stop losses if you are trying to catch this dump at this point. Be very protective. Let's see if we get a gap down open. If we do, the more aggressive the bears to the downside, the more I'm looking to be a buyer in the short term. But again, depends on travel as well. So the next 2 days, I'm not going to enter bad positions. And, if I'm trying to trade on my phone or things like that, I'm just going to sit all cash and let it all pass me by, rather than put myself in a bad situation trying to trade while, already having planned something a while ago. That's just me personally. We'll see you soon, maybe tomorrow. If not tomorrow, over the weekend. Have a good night.